Hey everyone, in today's video, we're going to be talking about 7 big stocks that just hit their 52-week highs. We're going to look over their stock prices, their stock charts over the short to medium term. Then we're going to look into their earnings per share. I'm going to give my 2 cents on if I think any of these stocks are overvalued, which ones may be still good buying opportunities in my opinions. So it should be a fun video. If you like this type of content before jumping into it, be sure to just give this video a big thumbs up. It really helps a ton with the YouTube algorithm. But we're just going to jump into stock number 1, which you can see on the screen here, is Chipotle. Chipotle, obviously a quick service restaurant, operates primarily in the US, but also in other markets as well. $60 billion market cap, trading at least from Google Finance around a 50 plus price to earnings ratio. Looking at this stock over the long term, it has done phenomenally well. Under $500 5 years ago, up to over $2,000 here today. And even just in the last 3 or 4 months, you see here up 40%. That is incredible for a restaurant stock at this size to begin with, to be up 40% in 3 or 4 months. Just on an absolute tear. Looking at their earnings per share here, going into the earnings tab. Their earnings per share estimated to be about $44 this year, $50 next year, let's call it. So even at next year's earnings per share, this company is trading at about a 42 times, around a 40, low 40 times price to earnings multiple on next year's earnings. Looks like it's closer to about 50 times this year's earnings. So this company is doing great. Phenomenal business, great results, but wow, are you paying for it? For a restaurant stock to be trading 40 to 50 times forward earnings is definitely somewhat priced in to have a very bright future. So great business. Congrats to anyone who's held it. If we look longer term, it's even compounded farther than last 5 years. If we go back even deeper here, so lots of shareholders have done really well with this, but in my opinion, in terms of just a risk reward, I don't see it in this one. So this is one that I'm not too interested in, but great quality business. You're definitely buying a great business if you own Chipotle shares, just not the right valuation for me, in my opinion. So that's the first stock here. Chipotle just hit 52-week high, touching 21.47 today. Closed at 21.23, so about 1% down from it. But you can see here they hit their year high on the day. Going into the second stock here, Carnival Cruiseline. So the cruise lines have been absolutely tearing it up lately. You see here, past 6 months, we're up over 116%. Even if I just went over the last 2 months, this stock has doubled in 2 months. So lots of these stocks that are at their 52-week highs, they've really been on an absolute tear over the last handful of months as the market's kind of settled, rebounded a bit. But Carnival and all the other cruise lines, worth noting, just some of the broader, longer-term stories behind their stock prices. So pre-COVID here, they were at about $50 a share. I think they were making about $4 to $5 earnings per share, trading at about a 10, 11 times earnings before COVID. I was actually, funny enough, looking at the stock right before COVID, so I dodged a bit of a bullet there. And it really had a hard time rebounding back, despite vaccine news and other things. They just kept getting hit, whether that was cost of gas or whatever it may be. It's really kept them down. They were down under $10 in March, and just recently on just reports of very strong demand and lots of baby boomers wanting to travel more, having lots of retirement income, and maybe travel becoming more of a staple than discretionary. It's really played into the story over the last month, which has a stock up 50%, but even 6 months and year to date, where we're seeing closer to 150% gains. Overall, company has about a $24 billion market cap. They took on a ton of debt and diluted lots of equity during COVID. So when we look at their balance sheet, it's not overly strong. It's actually pretty bad. And then from a EPS estimate, they're still anticipated to lose money this year, which is disappointing. When I looked at the company at the beginning of the year, some analysts had them actually turning a decent profit this year. Average was about flat. Now average is minus 16 cents a share. And then next year, average is for them to not even hit $1 per share. So let's say they hit $1 per share next year. Will be a bit on the optimistic side. Looking at their share price, they're at $19 here. So you're paying $19 next year's earnings for a cruise stock that has a battered balance sheet. And before COVID, the stock was trading closer to 10, 11 times. So this is another one that happy that equity holders have seen a huge increase in the value of their shares. But overall, I feel like this stock is not cheap by any means relative to what kind of earnings they're expected to pump out next year. So this is another one, just as I look at this in real time here, that I'm not really enticed to add this to my watch list or look at it overly closely, proactively here on out. But we'll see how the story plays out. Was really wild to see the stock jump over 50% in a month. I don't even think they reported earnings this month either. So really, really interesting to see how big of a move can be made on this sector, especially with all the shorts and stuff like that. Okay, going into stock number 3 that just hit their 52-week high. It is Church and Dwight. So this is a consumer packaged goods company trading at about $100 a share, 52-week high, maybe an all-time high. Oh no, it looks like they cracked $100 in the past. Close to a $25 billion valuation. You do get paid a small dividend of about 1%. Looking at this one's been a bit more of a steady up to the right, up 20% in the last 6 months. Year to date, about the same, but in the last year, just up 5. So it looks like they had some weakness. Now they're coming back, testing those all-time highs again at about $100. Long term, this company has performed really well, has a great track record on the stock. In terms of its earnings, expected to do $3 this year. Just over $3, and then growing 7-8% to $3.30 to $3.40 next year. So if I gave them $3.30 next year, the company's trading 30 times next year's earnings. It's another one that I don't fully understand. You can get really strong CPG companies, whether that's Coca-Cola, Colgate, Palmolive, whatever it may be. There's a list of them that, if anything, are probably more defensible, have wider moats, play in more geographies than Church and Dwight, trading at 22, 23 times next year's earnings, whereas the stock here is trading over 30 times current year and about 30 times next year. So it's another one that doesn't entice me too much, but interesting to check it out, especially since it just hit its 52-week high. Going down, just trying to see if there's anything that's jumping off the page that could be propelling it. Nothing out of the ordinary. And as I look at their annual revenue, it looks like they've had some decent top line growth year over year. Bottom line there has been a bit choppy, especially in the latest periods, but it may be some accounting going on there. So that's my thoughts so far. 0 for 3 in terms of stocks that I'm interested in adding to my watch list that are at 52-week highs currently. Going into the 4th stock, it is Delta Airlines. Delta Airlines hit $48 today. So they are at almost a post-pandemic high. It looks like they touched $48 once before. Now they're back to $48. So that's about a 3-year high, give or take. Pays a tiny dividend there. But this one's really rammed up over the last month. Similar travel theme that Carnival may be benefiting from, as well as Airbnb and such. Last 6 months here, let's take a look, up 40%. So 50% year to date, 40% in the last 6 months, 30% in the last month alone. This one is doing very well. Going over into the earnings per share estimate on Yahoo here. Expected to do about $6 this year. Really nice growth next year to over $7. So on $6 this year, This stock is trading really at a pretty good valuation, about eight times earnings, give or take. It looks like for this year, and then next year closer to 7 times earnings. So I know this one plays in a really tough industry in terms of airlines, and so many things can go wrong and wipe out profits, very low margins to begin with. But at least this stock here, despite being at a 52-week high, is trading at a really reasonable valuation, about 8 times earnings estimate, 7 times forward earnings estimate, and that's at the 52-week high. So for anyone who got this at $27 earlier in the year, they really bought the company at like a 4 to 5 times earnings multiple. So that's if those estimates actually come to fruition, that would deliver some great return on investment there. So best of luck to everyone in this one. I've never owned an airline before, so I still don't think this one's overly enticing. But good to see that not all stocks at 52-week highs are necessarily priced at a huge multiple or quote unquote overvalued. This next stock here, as we go into the fifth stock, is the only stock on the list that I actually own. At the beginning of the year, I actually made a video about how Visa is the top stock I'm looking to buy and add to make into a bigger position within my portfolio during 2023. So I've been doing that, but the rise in the stock price has kind of cut me off at my knees a bit in terms of how heavily I want to go into it. But yeah, I talk a lot about Visa in other videos, so I'll try not to go too in depth. But this is just a great company. Essentially, you get a royalty on the global economy in addition to further accelerators as card replaces cash in different areas of the world. They buy back shares, they increase their dividend, they have a lot of organic growth, really strong margins, proven scale. I can go on and on about this company. Up 15% on the year so far, just touched 238 today for the first time this year. Looking at their earnings, expected to do about $8.60 this year, about $10 next year. So even on next year's earnings, this one's still doing about 24 times earnings for next year versus this year's earnings closer to about a 28 times, give or take, earnings for this year. So personally, I think it's really reasonable valuation given the growth profile of the company, the history they have, the amount of value they've been able to create in the short, the medium, the long term with their business model. But definitely more pricey than some of the other ones that I own, and also that are in more fragile industries. So you can pay 1/3 the price per dollar of earnings for Delta Airlines as you can for Visa. So you just kind of pick your poison, what businesses you think are great businesses, and you'd prefer having exposure to. Personally, for me, I'd rather pay a premium for Visa's earnings stream than Delta's, but to each their own. Okay, going into the sixth stock here, to a company that I'm sure you've all heard of. It is Walmart. So Walmart has been up 27% in the last 1 year, 10% year to date here, trading at $158 for the first time here today. You do get a decent starting yield of about 1.5%. I also believe they increase it every year as well. And as we look at their earnings, current year they're at about $6.25. Next year is closer to $7. So even at next year's earnings, we're talking about 23, 24 times, and then this year closer to 25, 26 times on Walmart. I do like how defensive Walmart is. They have a big grocery business. They have lots of traffic. They also have a lot of growth avenues on e-com and marketplace and stuff like that. But I just don't think there's a ton of relative upside at 25, 26 times earnings. I also don't think there's a ton of downside, even if the economy decelerates a bit, just given Walmart's equity of standing for value and discount. And even as some people may flow out of Walmart or buy less at Walmart, maybe more people, instead of shopping at Target or more expensive stores, will turn into Walmart shoppers, or maybe just occasional Walmart shoppers for really big trips in a period of a recession or something. So I think it's a really defensive company. I think they're going to continue to crank out free cash flow, earnings. I just think they're pretty fairly valued here. So despite being at a 52-week high, don't think it's ridiculous valuation, but not enticing enough that I'm interested in jumping in, or I think I'll get superior returns from personally, in the short term at least. And going on to the seventh company. So this is the final company that we're going to be talking about here today that just hit their 52-week high, and it is Spotify. So Spotify year to date is up almost a double at 96%. Lots of that as we look in the last 6 months, which is actually very in line with year to date, is captured there. We see a big jump here right in January, probably a big earnings beat, but the stock went up about 25-30%. And since then, it's just steadily been going up, and to the right. Looking at Spotify's earnings forecast from analysts, just letting it load there. We can see that they're still expected to lose money, a lot of money this year, $2.60 a share. So that's about, I'm just trying to think of it as a percentage of their market cap. Let's call it 2% of their market cap. And their market cap, well, I thought I was going to say it here, but it's a significant amount of money. Next year, the high side analysts actually have them making money, which is a good side. Hopefully, if the average size comes to fruition, we'll see them at least just having a bit of a short loss. So for me personally, company that just doubled up. I know they're still very small compared to where they once were during the pandemic with low interest rates over $300. But I'm more focused on companies that have really strong cash flow today, less speculative, and building my income stream. So this is one that I would pass on. But I also think if it was one I did want to take a flyer on, it's tough to take that flyer up 100% in 6 months. So this is one that I'll just stay away from, but love their business. I subscribe and pay for Spotify on a monthly basis. So interesting to see how the stock does long term. Okay, so those are my 7 stocks that I wanted to go through today that just hit 52-week highs. So just a couple highlights to summarize here. Visa's the only one that I do own. It's the one that I'm most interested in still adding to. Delta is the one with the lowest price to earnings ratio despite being at a 52-week high, clocking in at around 8 times. And then some of these other stocks here, whether it's Chipotle at 40 times earnings, 40 to 50 times, Carnival in the high teens, Church and Dwight at 30 times, Walmart at 25 times, or Spotify still trying to get to that positive earnings, net earnings outcome. I just think that the valuations at these all-time highs or 52-week highs maybe have run a bit, or at least have taken out enough of the upside in the risk-reward equation to it not be enticing enough for me. So hope you like this content. If you did, be sure to like this video. It really does help with the YouTube algorithm. Also be sure to subscribe to the channel. Appreciate it a lot. And if you made it to the end of this video, let me know in the comments. Thank you guys a lot, and I'll see you in the next one.